Today, I'm going to explain why many Forex automated trading EAs fail, and the real reasons beginners often lose money with them. When people hear the word EA, they often imagine something like this. You can make money on autopilot. Even beginners can win. You don't need to watch charts. The system will trade for you. It sounds easy, but reality is different. But let me be clear from the beginning. An EA is not a magic system. In fact, if you use an EA without understanding how it works, it can be even more dangerous than manual trading. The pattern of beginners losing money with EAs is often very similar. First, they see beautiful performance results. Then, they mistake those results for low risk. Next, they want to make money quickly, so they trade with large lot sizes. But when drawdown comes, they cannot handle it. Finally, they stop the EA, or worse, they take a large loss. This pattern is extremely common. The reason is simple. They look only at the profits, but not at the risk. An EA is not a machine that makes you win. It only executes predefined trading rules automatically. If the strategy is bad, automation simply repeats bad trades faster and more consistently. Automation does not remove market uncertainty, losses, or drawdown. That is why an EA should not be treated as a holy grail. It is a trading tool that requires proper risk management. Now, let's look at the main reasons beginners lose money with EAs. 1. A beautiful curve can be a trap. The first reason is assuming that a smooth upward equity curve means the EA is good. When you see a chart like this, it looks very stable. The balance hardly drops. The account grows smoothly. For beginners, this looks very attractive. But this is one of the most dangerous points. In reality, every trading strategy has periods when it does not match the market. There will be losing streaks, there will be drawdowns. There will be periods of stagnation. So if an equity curve keeps rising smoothly with almost no drops, it may simply mean that the EA is not cutting losses. It may be holding floating losses while making the visible performance look clean. A beautiful equity curve does not always mean low risk. In some cases, the risk is hidden below the surface. On the surface, the EA looks stable, but inside, floating losses may be growing. Stop losses may be delayed. This kind of EA can suddenly collapse one day. This is a typical pattern where a smooth upward curve suddenly breaks down. This often happens with grid EAs and martingale EAs. Most of the time, they accumulate small profits. Their win rate can look high, but when the market moves strongly in one direction, floating losses can expand very quickly, and one large loss can wipe out the profits that were built up over a long period. The basic flow of grid and martingale risk is simple. Price moves against you, the EA adds more positions. If the price keeps moving against you, the EA adds even more positions. As a result, the exposure becomes larger and larger, and finally, the account faces the risk of blowing up. Even if small profits continue for a while, a very large tail risk may be hidden behind them. That is why, when evaluating an EA, you must not look only at how it makes money. You must also look at how it loses. 2. A good backtest does not guarantee the future. The second reason is judging an EA only by its backtest. Backtesting is important. It is very useful for checking the logic and long-term behavior of an EA. But a backtest does not guarantee the future. A backtest is simply the result of applying a strategy to past market data. If the parameters are adjusted too closely to past price movements, it is possible to create a very beautiful backtest. This is called over-optimization. 3. A few good months can mislead you. The third reason is judging an EA by short-term forward results. A forward test is closer to real trading because the EA is running in the actual market. But judging an EA only by a few weeks or a few months of forward results is dangerous. As you can see here, even an EA with a win rate above 90% can later collapse. A 90% win rate sounds very attractive, but a high win rate and low risk are not the same thing. For example, imagine 9 winning trades Each win gives you +1, so the total profit is +9. But then, one losing trade gives you -15. In that case, even with a 90% win rate, the total result is negative. What matters in EA trading is not only the win rate. You need to check the average profit, the average loss, the maximum loss, the stop loss rules, and how much the EA can lose in a single losing trade. 4. Drawdown makes traders panic. The fourth reason is stopping the EA because you cannot tolerate drawdown. Many people think that automated trading removes the emotional side of trading, but in reality, psychology is still very important. When you run an EA with your own money, drawdown periods are emotionally difficult. Floating losses increase. Your balance goes down. Losing trades continue. Then you start thinking, maybe this EA no longer works, and you feel like stopping it. This is an example of an EA that I am personally running. There was a difficult drawdown period, but after that, the EA recovered and started growing again. Of course, you should not keep running a dangerous EA blindly. But if the drawdown is within the risk range you expected in advance, it may be better to follow your rules instead of stopping emotionally. If we look at the long-term backtest of this EA, we can see that even within an upward trend, there are drawdowns and stagnation periods. In other words, short-term weakness was already expected from the beginning. If you stop the EA just because it enters a temporary bad period, you may cut the strategy before its original expectancy has time to play out. Drawdown does not always mean that the strategy has failed. Is it just a temporary slump, or is the logic truly broken? The important thing is to make decisions based on rules you decided in advance, not based on emotions. 5. Demo accounts can give false confidence. The fifth reason is blindly trusting demo account results. On a demo account, the performance can look very beautiful. When you see a graph like this, you may think the same results can be achieved on a real account. But demo accounts and real accounts are not the same. In a real account, actual liquidity, spreads, slippage, execution delays, and the broker's execution environment can affect the results. This difference becomes especially important for scalping EAs. In a real account, the result may not be reproduced as smoothly as in a demo account. Even if performance rises strongly for a while, a large drawdown can appear later. It is dangerous to judge an EA only by demo account results. Scalping EAs in particular have a major reproducibility problem. On a demo account, the EA may benefit from ideal execution, tight spreads, very little slippage. Under those conditions, the results can look good. But a real account is different. Spreads can widen, slippage can occur, execution can be delayed. These small differences can create a big difference for scalping EAs. The smaller the profit target, the more sensitive the EA becomes to trading costs and execution quality. So you should not assume that if an EA works on demo, it will also work on a real account. 6. Bad lot size can kill a good strategy. The sixth reason is poor money management. One of the biggest reasons traders lose money with EAs is lot size. Even if a strategy has an edge, if the lot size is too large for the account balance, even a small drawdown can seriously damage the account. This is especially important for XAU-USD or gold EAs. Gold moves a lot, and in recent years, the price range has become very large. Even the minimum lot size of 0.01 can be risky depending on the account size. In this example, the drawdown reached over 95%. The account was almost at the game over point. Even if the EA logic has positive expectancy, if the lot size is wrong, the account may not survive long enough for that expectancy to appear. Even with the same strategy, the result can be completely different depending on the lot size. With a small lot, the account may survive the drawdown and recover. But with an oversized lot, the same drawdown can become an account blow-up risk. In other words, money management is just as important as the trading logic. When operating an EA, you should not only ask, can this EA win? You also need to ask, can this account size and lot size survive the expected drawdown? So, Should you avoid EAs completely? The answer depends on how you use them. If a beginner treats an EA as an easy money-making system, then yes, it is probably better to avoid it. Buying an EA only because the results look beautiful, trusting only short-term forward results, believing demo account performance, trying to grow the account quickly with high lot sizes, running the EA completely hands-off without understanding the logic. These are dangerous ways to use EAs. On the other hand, not all EAs are bad. An EA is simply a tool that automatically executes predefined trading rules. It can reduce emotional entries. It can execute rules consistently. It makes backtesting and forward testing easier. It can help manage multiple strategies. These are real advantages. The important thing is not to treat an EA as a holy grail. You need to treat it as a trading system that requires risk management. Now, let's summarize the key points. An EA is not magic. A smooth upward equity curve may be hiding risk. A backtest is based on the past, not a guarantee of the future. Short-term forward results are not enough to understand the real risk. Even a high win rate can be destroyed by one large loss. Demo accounts and real accounts are not the same. Scalping EAs especially require caution because of reproducibility issues. And if the lot size is wrong, even a good strategy can fail. When choosing an EA, the most important question is not only how much is it winning, you must ask, how does it lose? How large can the drawdown become? Can my account size survive that loss? An EA is not a holy grail, but it is not something that should be completely rejected either. For traders who understand the risks, test properly, and manage capital carefully, an EA can be a useful tool. But if you want to make money easily, if you do not want to think about difficult things, or if you believe that beautiful results mean the EA is safe, then EA trading is probably not for you. Before looking for a profitable EA, you first need to understand what kind of risk tool a Forex EA really is. If you found this video helpful, please like the video and subscribe to the channel. At Forex Robot Lab, I share EA reviews, how to identify risky EAs, and how to read backtests and forward tests properly. Before using an EA, understand the risk first. That is the first step to surviving in the long run.